I only invest with the Aristocrats. I'm a terrible actor. That was supposed to be a British accent. Either way, Dividend Aristocrats, that's what we're talking about today. You've probably heard of them. If you haven't, you've heard of them now. And in about 4.5 minutes, you're going to know everything you need to know about the Dividend Aristocrats. Hi, I'm Antonio Cibella with Vision Wealth Management. Welcome to our latest video. We're talking Dividend Aristocrats today, specifically a certain type of dividend-paying stock and whether it has a place in your retirement plan. So, to start, what's a Dividend Aristocrat? Well, you take the S&P 500 largest companies based in the United States, and you start looking for dividend payers who have a 25-year history of paying out a dividend and growing that dividend. Right now, early 2022, there are 66 Dividend Aristocrats. Again, companies that pay a consistent dividend and have done so and grown that dividend for a 25-year period. You might not be familiar with what a dividend is, so we're going to talk about that. It's a return of earnings to shareholders, to the owners of the company. So if you buy stock in a company, you're an owner of that company. The company earned money, and companies that pay a dividend take a piece of those earnings and send it out to you quarterly as they announce their earnings. So companies that essentially pay rent, if you will. They're paying you to own the stock by returning some of the money that they're making rather than just reinvesting that money back into the business. So companies that have done that for a long period of time and have historically grown the amount that they're paying meet this qualification for the Dividend Aristocrat Index. And then a lot of folks will use those dividend paying stocks as income in retirement because they're receiving regular distributions from the stocks they earn, and they also have the potential over time for growth in their share price. And so it can be a good way to return retirement income without just spending your assets down. So today that's what we're going to talk about. We're going to talk about how you can do it and what risks you might have in doing that. So as I mentioned, there are 66 Dividend Aristocrats right now. A couple of ways that you can go about investing in them. Lots of acronyms here. There are ETFs, there are UITs, or you could DIY, you can do it yourself. Let's walk through them. So an ETF is an exchange-traded fund. You can find ETFs that just mirror the Dividend Aristocrats. So they'll say, hey, you buy this one ticker for this fund, and we're going to own all 66 of the Dividend Aristocrats. We'll make the changes as companies would come into or go out of the index, and that's it. Relatively low expense compared to many investments, and it's just sort of set it and forget it, and it's there. The second option, a unit investment trust or UIT, is a pooled investment where you're going to invest into the trust. The trust is going to buy the shares of actual stock. Most of the time with these, there's some additional analysis that goes in. So they won't just buy all, for example, 66 companies. They'll say, we'll use that as our starting point, and then we're going to select which companies to buy out of that from looking at their balance sheet and the amount of debt that they have and what their payment history is and what their future outlook is. So you're hiring a manager to select the companies that they like out of those 66. They have a specific time frame. At the end of the time frame, you can roll it over into a new trust, provided that they're going to offer the next version of it, or you can take the shares of stock of the companies that you own. Most of the time, they're buying 20, 25, maybe 30 out of the 66. And then the third way, DIY, do it yourself. You can simply use the 66 stocks as a starting point and either buy shares in all of them, buy shares in some of them, or work with your advisor to figure out which ones you should be purchasing. As a general rule, some real round analysis. Look for companies who have a low amount of debt. You're looking for stability here. You want the dividend to continue because you're relying on it for retirement income. So you want companies that don't have a ton of debt because that might limit their ability in the future to pay out those dividends. You want to look for a company that has a relatively low dividend payout ratio. What that means is how much of the earnings that they have are they returning to you in the form of a dividend? Because if they're sending out all of the money that the company is making as the dividend might look really good. There's no way to grow that. How are you going to grow the dividend? You have to make more money to be able to grow that dividend versus we're paying out a portion of what we're earning. We've got the potential to grow it. Even if the top line doesn't grow, it's also maybe a little bit more of a secure dividend because, again, they're not paying out every last dollar they're making to meet that dividend. So dividend payout ratio is a big one. Let's talk about the risks of dividend paying stocks in retirement. So the risk is it's a stock. It's going to be more volatile than some other income-oriented investments, for example, bonds, or if you were to make direct investments in real estate, those tend to be a little bit more steady, not the same volatility as stocks. Now, capitalized companies with a very long dividend history tend to be less volatile than maybe a small cap growth oriented stock, so they're not going to fluctuate quite as much, but they're still a stock, so you're going to have a fair amount of volatility there. You've got to be able to make your peace with that and work from the dividend and be comfortable with the volatility that you have in dividend paying stocks if that's what you're going to rely on for a substantial portion of your retirement income. You don't want to sell when things aren't going well, because that can really disrupt the plan. So the big risk there is volatility. Also, you want to make sure you're diversified as with any other investment, so you don't want to pick like a stock and put all of your retirement money into it and then go, hey, I get this great dividend from this one company, because you literally have all your eggs in one basket there, and as we know, that's not a good plan. So Dividend Aristocrats, companies that have a strong history of paying dividends, can be useful in a retirement plan if you're comfortable with the risks that they have. That's the video for today. I appreciate you sticking around. If you have questions, feel free to hit me up, send me a message, that sort of thing. I will talk with you soon. I thank you for being here. I hope you learned something, and I'll see you soon.